Is the current bear market making you want to panic sell your Acorns portfolio? Because I get it. Seeing those red numbers flash can be terrifying, especially when you're using an automated investing app like Acorns where you're used to just setting and forgetting. But what if I told you that a bear market isn't a disaster, but a massive buying opportunity? I've been using Acorns through multiple market dips, and I want to walk you through the single best strategy you can adopt right now. It boils down to 3 words: stay the course. 1. Maintain consistent investing, dollar cost averaging. The core of the Acorns platform is dollar cost averaging, and it's never more powerful than in a bear market. This means investing a fixed amount of money, whether it's your round UPS, your recurring daily, or your weekly deposits, on a regular schedule, regardless of what the market is doing. The experience: when the market is high, your recurring $10 is buying fewer shares. When the market is down, like it is now, that same $10 is buying more shares. I have personally seen my average cost per share drop significantly during these downturns. This is you buying assets on sale. The action: do not stop your recurring investments or round UPS. If you can afford to, increase them. You're effectively stockpiling shares at a discount, positioning yourself for massive gains when the bull market inevitably returns. 2. Do not change your portfolio, stick to your risk profile. Acorns determines your portfolio, from conservative to aggressive, based on your financial goals and time horizon. A bear market is not the time to suddenly go more conservative. The experience: when I saw my portfolio value drop, my gut reaction was to switch to the moderately conservative setting to stop the bleeding. I resisted, remembering I'm investing for the long term, decades, not months. My aggressive portfolio is designed for this volatility. Switching now would mean selling my existing assets at a loss and then reinvesting in safer assets that won't recover as quickly when the market turns. The action: trust the initial risk assessment. If you're decades away from retirement, the aggressive or moderately aggressive portfolios are what you need to maximize growth during this buying opportunity. Do not panic switch. 3. Use Acorns Later and found money. If you have an Acorns Later (IRA) account, this market is the perfect time to maximize those contributions. You are buying retirement assets, which you won't touch for decades, at incredibly cheap prices. The experience: I have been prioritizing funding my Acorns Later account because the assets in there are on deep discount. The short-term volatility means nothing when my time horizon is 20+ years. Every deposit I make today is buying cheap shares that will compound for decades. The action: focus on maximizing your Acorns Later contributions. Also, utilize the Found Money program. Those deposits from partner brands are essentially free money buying you discounted shares. This is not a get-rich-quick scheme. This is disciplined, long-term investing. The true strategy is to look at the downturn, recognize the sale, and keep feeding the beast with your small, regular contributions. Your future self will thank you for having the discipline to buy consistently when everyone else was selling. With that said, thanks for watching, and until next time.